Welcome to Cherry Street Investor Education with Kavita Baratake, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast track your financial goals. Here's your host, Kavita Baratake.
Good evening, everyone. Again, I'm Kavita Baratake. Thank you guys for joining in this presentation. I usually present on a lot of different topics like investment-related topics, tax-related topics, legal topics, and I get in a lot of guest speakers to come talk about different things. If I'm not the main person doing these kind of investments, if I'm talking about multifamily or some other kind of investments that I'm active in, I usually present this myself. But what I realized from interacting with a lot of people is that they really didn't understand the foundations of some of these topics, like passive income. A lot of people don't understand what passive income is, really. And I just wanted to kind of roll back and start from the basics. And this is an effort to just start from the basics and look at what passive income is, what are assets and liabilities, what are all these things that people talk about, and just go back to the basics. So today we're going to talk about what passive income is, what are assets and liabilities, what is a cash flow quadrant. Just a quick raise of hands, show of hands. If has anybody read the book, Rich Dad, Poor Dad? Show of hands. I see 2 hands up. Okay. 3 hands up. So, okay, that's quite a few people, not too many people compared to the number of people on this call right now, but I'm going to be covering a lot of basics that book covers, but I also have a recommended reading list for you guys. And for those of you who don't like reading, I highly recommend listening to audiobooks. Maybe you're out for a walk with your dogs, or you're doing something else while you're listening in. That's a great way to read without having to read if you're not much of a reader. I love reading, so I do still listen to audiobooks because I'm driving long distance to Dallas and Houston often. So I just listen to books on the way. So today's presentation is meant to kind of take you through the foundations, but I highly recommend taking it beyond this and doing your own work in going beyond this, okay? I'm trying to move the presentation here. All right. A quick disclaimer here. I'm supposed to provide this because I am going to talk about some tax topics. I'm going to talk about some legal topics. So just understand that this is only for education. I'm not providing you any specific advice to go invest here or there in this particular presentation. And please consult your own financial advisor, attorney, or CPA for all specific tax situations or legal situations that you are a part of. Before I get started, I wanted to kind of roll back and talk about myself and where I came from, where I am, and how I got there. And just to kind of give you an idea of my own journey. So I'm kind of dating myself here. This was my first birthday in Bangalore, India. I'm 75 born, obviously. And I was about 9 in this picture, I think. And this was in Chicago when my nephew was born. And I somehow missed a lot of pictures in between. I wasn't big on picture taking, so I really didn't have a whole lot of photos. And back then, a lot of old people like us know that, you didn't have a phone to snap pictures every time you wanted. Anyway, I stopped this timeline at 2007 because this was sort of a turning point in my life where I was either living with my father or I came to the US 1998, and I thought I was independent at that point, but I quickly got married in 99. So sort of handed over from my dad to my husband, or then husband. And I really didn't financially have to make these decisions, a lot of these decisions, until I got divorced in 2007. So it was a pretty big turning point for me because I realized my own capacity to do things and really came to understand my own intentions and my own goals in 2007 when I got my divorce. So my story starts here actually in 2007. And the biggest reason for me to really think about financial independence and to really focus on how I'm going to I didn't want this traditional idea of retirement. I did not want to wait till I was 65 to retire. I did not want to work for someone else. I knew those things, but I just didn't have any idea of what I'll do or how I'll get there. So I think the big strong was my why. My why was my family, my daughter, my pets, my dad, my mom, who live in India right now. And I really wanted to spend more time with all these people. And that was my strong why. And I always tell people, when you think about what your life should look like, think about why you want that, because that makes it very compelling, right? When you have a strong why, you're compelled to do things, but even if it might get difficult along the way, and it will, right? I've had my share of difficulties along the way, but my why keeps me going. So you really need a strong why when you want to start thinking about financial independence, because there will be a lot of roadblocks along the way. And if your why is strong enough, you'll overcome them, right? You'll overcome the fears, the beliefs, the limiting beliefs you have, the roadblocks you have. And I find that from talking to investors, most of it is the mental work and less of it is actual money work. So money is all about our mentality around it, our mindset around it. So talking about my investing journey, I told you I moved to US in 1998. I rented my first apartment for $650. It was a 2-bedroom and we had 4 people share it. So my rent portion was $225. And I was making a $1,300 income as a full-time grad student at Texas A&M. And interestingly, the name Cherry Street, I lived on Cherry Street when I first moved here. So that's where I got the name for my company from, because it was my journey from renting an apartment to actually owning apartments at some point, right? And so on the right side, it's one of the apartments that we sold in 2019. By this time, I was financially free. I had built a portfolio of houses and apartments. I was getting income and I was done, right? I quit my job. And I was full-time investor and a financially free investor. So that 20-year journey, I actually got financially free around 2017, but I didn't quit because of other reasons. So around 20-year time frame, on less than 20-year time frame, like really from 2007 to 2017, 10 years, I was able to achieve the goal, right? So I believe that we are again at a cycle that it will present a lot of opportunities. And if people are really focused and they know what they want and go after it, you will be able to achieve your goal in 10 years or less, if you do the right things. So let's talk about what that looks like, right? Before that, just to give you an idea, timeline, 2008, I started stock option trading. If anybody here done option trading, raise your hand. All right. So it's the 2 people raise their hands. It's the riskiest form of trading you can do in the market, but I did educate myself and I actually made a lot of money and I lost a lot of money. So that's kind of how it works in options. It's a very risky game and you play it, but I did come out really positive. And so when I decided to quit options trading, it was 2 reasons. One was it was just up and down and all over the place, really time consuming. I didn't find anything about it passive. It was very active and I was spending my time glued to the screen. And the quality of life was just as important as as the money I was making. So I didn't want to live like that. The second reason was I wanted to really grow it in some place where I thought it could be more stable and sustainable over the long run. I didn't want those swings. And I felt like when we lose or make money, a lot of our emotions move with it. And the best investors don't do that, right? It's hard to be that person who doesn't lose their who are able to lose and still keep going, and who are able to gain and still keep going. So if you can have that kind of mindset around money, it'll make you a really good investor. But those are the lessons I learned in 2008. And so 2009, I moved and bought my first house in Austin for $98,000. And I did that until 2017, where I got to a point of buying enough homes on a single income. And I could probably do another whole presentation on how that journey was, but that's not the point of today's presentation, right? But 2009 to 2017, I kind of refinanced and moved money around from one rental to another. And as the rentals grew, I moved money out and bought new rentals. So I got tired at 2017 of all the single family homes, and because I was managing it alone. And I really wanted to do something which was more scalable. So I moved into apartment investing. I quit my job in 2019 once I moved into apartment investing, because I realized that was a business that I could sustainably run and scale, and I could help others do what I have already done. And I was financially free at that point. So what I do in my company, that's Cherry Street, is host webinars like this one on investments, taxation. I have a YouTube channel you can visit. I help people create passive income and equity through investments in real estate assets, and also work on structuring high cash value life insurance policies. And so you can actually use a life insurance policy as a tool to invest into real estate. It's a concept called infinite banking. So you can look it up. So these are some of the properties that we have bought. I have an ATM fund and a car wash fund currently open, but yeah, we have a bunch of properties, and some of you guys online today are investors in some of these properties. So enough about me. Now let's get to the financial freedom roadmap. Here is what I look at, how to get from where you are. You might be somewhere in the middle of this. You might be at the beginning. It doesn't really matter. I think it's a personal journey to go through this, and it's never really over, right? So that's why I have the whole rinse and repeat, because I'm really not where I'm financially free, but I think there's always things that I would work on. There's always things that I'm learning as I go along. And for example, this economic market has been a big lesson, right? To understand how to deal with adversity in the market. So let's talk a little bit about defining your why and your mindset. I believe that this is the biggest issue that a lot of us struggle with, is the mindset. It's not all of the other things. It's the mindset around money. One is defining your why. Like I said, if you have a strong why, it becomes a lot easier to understand, to go to that goal, because now you are going to work past any roadblocks that you have, whether you say you're too busy, you're too, I don't know, you have kids are taking up too much of your time, you have other things going on. So to give you an idea, I worked every weekend for the last 10 years until a couple of years ago, right? Till I quit my job. So I worked every weekend because I had to work every weekend. Otherwise, there was not enough time in the day during the week. So when you really want a goal, you just make it happen. When you really enjoy doing something, and that was the best part. I really enjoyed doing real estate. I enjoyed going to events and meeting new people, learning more about real estate. I enjoyed that whole experience, so I didn't look at it as work. So I think that's the mindset that we have to have. You have to change your mindset about it, shifting from, oh, this is a lot of work, to this is enjoyable, right? And if you're really not enjoying it, you can't really enjoy the journey. Maybe you should look at something else, not real estate. See, it doesn't really have to be real estate. I have known people who have retired from their jobs with a variety of different things, not necessarily one thing. Right? So they're focused on something else. Like someone has opened an Amazon store and retired. Someone has opened a car wash and retired. So everybody has their path to that financial freedom. It doesn't have to be, my path doesn't have to be yours. So you want to create that mindset. You want to create a structure around your schedule, right? Where you allow for this extra work that you have to do to get there faster. right? Because a lot of us can continue working 20 more years, do the same thing in and out, and not be happy with it. If you're happy with it, that's great, just continue working. But if you're unhappy with it and you really want a change, or you might be happy with the job, but you really still want the freedom to say, if I don't want to work, I should be able to take off, right? Or if you want to spend more time with your kids, you should still be able to take off. So that's the goal of this whole exercise. And you want to set some goals. So let's say you set a 1-year goal or 5-year goal. All of you guys, I'm sure, are professionals. You know how to set goals. Set SMART goals, right? Like specific, measurable. I don't even have to talk about all that. Like a lot of project managers on the call, I'm sure. So the second thing I'll say is learning. This is where I find a lot of people will cut back and say, I don't have time for, or I don't have inclination to. And I feel like if you stop there, you're really never going forward, right? You want to choose a focus area. Like I chose single family homes initially. I chose apartments later, but I chose one area, and then that's all I did for a while, right? So you might choose to set up an Amazon store. You might choose to, I don't know, do something else, but you have a specific focus. You commit time towards that. You go to conferences, you go to events, you immerse yourself completely into it. That is the only way to learn, right? I went to almost 50, 60 conferences over a few years just to learn, just to be completely in that network. Because once you create that network and immerse yourself into that network, you're going to learn. There's no option. And you're going to learn really fast. And you're also going to see and be surrounded by a lot of people who are more successful than you in the monetary terms, perhaps, but who are where you want to be. That's really the key to doing and accelerating your goals faster, is to find people who have already achieved your goals, right? And surround yourself and learn from them. So I really think the learning phase is super important besides the mindset phase. And then there is execution, right? So a lot of people get stuck sometimes in the learning phase because of analysis paralysis, and they never really apply anything that they learn because they have fear, they have what ifs, and all of that stuff. So if you don't apply it, then it's all for nothing. So I have this philosophy of saying, just do it. The worst case is you fail. The best case is you learn. You might lose some money, but you learn really quick. So you apply that knowledge, you start creating savings. And some people will say, I don't have enough to save, right? My income isn't enough. I was on a single income. So I started trying to figure out, how could I increase my income? I switched jobs to increase my income. Maybe you want to figure out a side gig to bring in some income, right? If the income is not enough to save, maybe you have enough savings, then figure out how you're going to invest those savings. What are you going to put it in? Like I said, the what you're going to invest in doesn't matter. You just want to be educated about what you're investing in. That matters, right? Finally, you start seeing the results. And you start seeing increased cash flow, increased net worth. You can reduce taxes depending on what you're investing in. And we'll talk a little bit about taxation. The best way to increase your income is actually not just taking another job or trying to work harder, but is just to actually reduce your taxes, because you're putting in the same amount of effort. But once your taxes go down, your net income goes up. Right? A lot of people don't really understand how to deal with the tax component, and there are a lot of ways to deal with that. So finally, you want to protect your assets because you're building assets. You want to figure out how to protect them because, the world is a big bad place. So you want to learn to protect what you're making, and then rinse and repeat. Because honestly, I have been through the cycle multiple times with different assets, right? And I continue to learn. And I feel like our life is an endless process of learning. So we're always going to learn something new. So I want to talk about money mindset shift. I've talked to probably about, 800 investors in the last 4 years. Sometimes 5-6 investors in a day, a lot of investors over the last 5-6 years. And one of the things I've found is that the mindset shift is the hardest shift to make because a lot of us grow up with beliefs around money. So let me give you an example about my own beliefs around money growing up. My parents told me things like money doesn't grow on trees and, there's not enough money to go around. So I grew up in a household where there was always a lack of money. And there was always a lot of arguments around money, right? Around money not being enough. And so there were two ways to look at it. One is there is not enough, or the other way is to look at it was I will never live in a situation. I'll always make my life in such a way that I'll always have more than enough of money. So in second grade, actually fourth grade, I wanted a bicycle. It was called BSA SLR, probably cost about, I don't know, $10 or less in today's money back then in India. And that was a lot of money. So I didn't get that bicycle. And that's all I wanted when I was a fourth grader. So and now I could have taken that story as I'll never have anything I want, or I told myself that I will, as an adult, when I grow up, I will never want anything I cannot have. So anything I want, I can have if I want to. So that was the belief that I developed. But there were still other beliefs that I wasn't good about. So it was a lot of examination of my own beliefs around money. And also this idea that if I got too much money, oh, money is evil, it's going to make me a different person. It doesn't, right? They say money makes you more of who you are. So if you're bad to start with, it just becomes worse, right? So you really want to examine your own beliefs and discard the beliefs that don't serve you about money, because everybody has them. We all grow up in environments where we examine, we are brought up with certain beliefs. And I believe that almost 80% of the people have issues with money, because if they have issues with money, have it because of their beliefs around money. Whether they think having too much money makes them a bad person, money is evil, money doesn't grow on trees, money is this, that, stories around money. So it's important for us to change those narratives around money. And second is to adopt an abundance mentality. And that's a hard thing, right? Like we have to grow up and we have to say, if I choose to think this way, I'm going to change my mentality and say, I don't care if I don't have enough, I'm going to focus on what I do have. So, and it's not just money, right? This applies to every aspect of our life, right? And change your money persona. I thought this one was a really interesting thing. So let's say you want to lose 20 pounds, right? You have to start seeing yourself losing 20 pounds as a skinnier person, right? Similarly with money, you have to start seeing yourself being rich, achieving your goals before it happens. And I know Joseph Ria is a coach here and he'll attest to this. This is so important in every aspect of our life. And I still struggle with it in some aspects of my life, but financially, I don't struggle with it, right? I just whatever, it's not important. Money isn't important. There's going to be enough of it. That's my mentality towards money. The other one is, as I mentioned earlier, you have to invest in your financial education, because you're just not going to grow up, wake up and make it happen one day, right? And the last one, but not probably the most important one, is to, like I said, surround yourself with the right people, the people who have already done it, the people who are where you aspire to be. And that honestly makes it so much faster. It really accelerates what you're doing. Because if you have a very passive way of investing and saying, okay, I'm just going to invest and I'm going to sit back and do whatever I'm doing, it's not going to take you. It's only going to take you that far. You really need to immerse yourself in something to really go far and fast. All right, so let's talk about this important concept of assets versus liabilities. I'm actually doing a class for kids 10 and up starting next month, and we'll be covering these very basic topics with the kids as well. So understand what assets are and what liabilities are. So a traditional definition of an asset is if you look up the dictionary definition, is useful or valuable thing, person, or quality. So in a financial sense, it's a valuable thing, right? That's all it is. But our definition, also the Rich Dad definition, if you read the book, is an investment that puts money in your pocket. So if something that you bought isn't putting money in your pocket, it's not an asset. So let me give you an example of what's not an asset, right? It's your house that you think you bought is an asset. It's really not an asset. Maybe the appreciated value is an asset if you can recover the money, but by itself, it's not an asset because you're paying money to keep the house. So let's talk about what are assets. Cash flowing real estate, money that comes from a rental property. If you bought a rental property that isn't making you any money and you're actually having to dump money into it, it's not an asset, right? If you're holding on for appreciation, hoping that appreciation is not going to happen, it's not an asset. If you're buying dividend stock and you're getting monthly dividends or quarterly dividends, that's an asset. If you have royalties, you wrote a book or you did something that you're earning royalties from, that's an asset. If you have a car, but it's on Turo and it's making money for you, it's paying off all its liabilities, which is the loan and the insurance, but it's cash flow positive, that's an asset. So you can have a car, which is an asset, and a car, which is a liability, right? The car that you drive is a liability because it's just taking money out of your pocket. So again, on the other side, a liability simply takes money out of your pocket. Your personal home is a liability. Your credit card debt is a liability. Your auto loan is a liability. Loans of any sort, generally liabilities, right? But if you, let's say, take a loan of some sort at 4% or 5%, and you go invest that loan at 6-12%, and now you're cash flow positive from that loan, that can be an asset. Let's talk about what active income is passive income is. I got involved in this discussion on one of the Facebook groups, and I just understood from that discussion, it was just something someone posted about needing passive income, that almost 80% of the people who commented on it did not understand what passive meant and what active meant. So the definition again is quite simple here. If you're exchanging your time for money, it's active. If you are investing in an asset, an income producing asset, it's passive. Okay, so now let's take a rental property. It might require a little effort initially to get it started, but on an ongoing basis, if the checks are coming into your bank with very little effort, it's still a passive income, right? But let's say you're running a short-term rental business, it's less passive because you're putting in a lot of effort into it. So it's more of an active income there. So the problem with active income tends to be, from an IRS perspective or tax perspective, it's called earned income. It's usually reported on 1099 and W-2, usually has one of the highest tax rates, and also has very few options to reduce taxes on this kind of income. So if you're in that active income category and most of your income is coming from there, you're not going to really find too many ways to remove or reduce taxes on this. Right? So let's talk about self-employment. Some people think, oh, I'm a realtor. I have passive income. No, you don't. If you are working and you get paid, if you stop working, you stop getting paid, that's active income, right? When you're active, you get paid. When you're passive, or when you stop working, you stop getting paid. That's not going to help you any further with taxes, because you still have to actually, self-employed people pay twice the FICA taxes that they pay, the employee portion and the employer portion, to make it worse. So they actually pay even more taxes, the self-employed, than being an employee. So a self-employed person might be a dentist running its own practice, doctors, realtors. You might be consulting, doing a 1099, kind of a job. You'll still pay pretty high taxes. Now, on the other side, which is passive income, that's where you really have options to not only stop working or trading time for money so much, and then also have options to reduce taxes. right? Especially when you do real estate assets. So that could be rental homes, passive real estate investments. You wrote a book. Yeah, you could write a book and collect royalties for a very long time. You could have affiliate income. So let's say I'm a social media influencer. I have a YouTube channel. I refer and I do a video sometimes on like, hey, you should try this product. And then that product folks send me income every month because I am referring clients to them. They're buying their products. That's passive income. I'm not doing a whole lot of work. I might be putting an hour to refer them to someone else. So I'm not constantly working. And the best part is, let's say I did a video to talk about a referral to a product, and then I stopped doing any referrals, but that video still lives on and it continues to generate referral income. That's truly passive because I'm not putting any more time into it. So this is a very interesting slide on how the rich and the middle class are different in terms of cash flows. So let's look a little bit at this couple of things, right? One is an income statement. An income statement basically has in net income coming in and then net expenses going out. And in your case, let's say you are an employee, your income statement might just be your salary, or maybe you have some stock dividends here, and your expenses are all the expenses that you have to deal with every month, right? That's your income statement. Now, your balance sheet has assets and liabilities on it. Simple, right? So assets, you could hold a bunch of assets or you might have nothing. Like I said, if you think you have a house, you don't have an asset, you actually have a liability. So most middle-class people are here. They don't really have any assets. They have cars. They have a single-family home they live in. They have credit cards. They have school loans. They might have some other things here, like some more loans. But this is pretty much the picture of most of a middle class. I was here, so I relate completely to this. So every month my salary came in and it paid for all my bills. Right. So all the liabilities, all the bills that I had to pay, and whatever I could save, I saved. I saved and put it in a bank. And that's all I did for a while. Right. Maybe I bought some stock. So I had a couple of stocks in the assets column, and the values went up and low, down and up, down and up. I thought I was making money. I wasn't really sure how much money I was making. So it was sort of like that. Maybe I had a 401k. Right? I had a 401k, so that was probably an asset. So some of them just live like salary to liabilities and zero income and zero savings. So this is typically how the middle class have what the middle class has in terms of cash flow. Now you look at the rich people, what they do is really create a lot of assets here. So they're investing all over, like whether it's intellectual property, real estate. The reason a lot of people invest in real estate is because it affords the best tax benefits. So when you understand the tax benefits from real estate, or even running a business, even businesses end up buying a lot of real estate because of tax benefits. So that's why a lot of people who are rich have a lot of exposure to real estate in their portfolios. Then you have your mortgage. They still have all the mortgages and loans that people have, but a lot of their income is, instead of a salary, they might have rental income, dividends, interest coming from investments, royalties, and their expenses are taxes and mortgage payment, right? They usually don't keep a whole lot of the other things. I don't have a credit card payment. I usually don't even keep a car payment. I do have one right now. But what's beautiful is that as you create more assets, which create income, they pay for the expenses. So you're really not depending on a salary to come in. Like, so I'm not exchanging my time for money. I'm not depending on a salary to pay my expenses. And that's really where we want to get to, is that the income pays for the expenses, and the income is not earned income, it's passive income. So the advantage of doing this is when you can have passive income working for you, you can actually start doing something else that you enjoy, and that creates even more income, right? but you don't need it anymore because you're living on the passive income. Now you can start investing that income coming in into more assets. So you can start snowballing that effect of creating more and more assets, and that creates more and more income for you in the future. So that's kind of the pattern that we want to get into, is what the rich in this country have been doing and are doing all the time. And what's interesting is the income on this kind of passive income, the taxes on this kind of passive income is lower. And there's also other ways when you are a full-time investor to exploit and reduce your taxable rate even more. You don't have those options when you earn income. So you could make $500,000 here and pay 10% tax rate or lower. You could make $250K here as a salaried person and pay more than 40-50% in taxes. So this is where it's really important to understand how tax impacts your income and the savings left after that. So that takes me clearly to this slide, which is very, very important and very foundational to understanding why you need to shift from being an employee, to other places in this quadrant. So the four pieces of the quadrant are: you're either an employee, you are a self-employed person, you're a business owner, or you're an investor. So bottom line is this: as an employee, the amount of active work is determining your income. You can put as much time as you want, but there's a limit to your income, right? That limit is like, maybe you're getting a 10% hike every year, great, but there's still a limit. There's an upper limit to what you can make. As a self-employed person, maybe your upper limit is higher because, you're giving less away to someone else, right? You can choose the amount of work. But let's say I don't want to work 1 year, my income is zero. So I'm still trading time for money here, right? And what's interesting is there's little or no tax breaks on this side of the quadrant, on the left side of the quadrant, which is demarcated by this red line. There's very little or no tax break. So the reason is the money you're working here on this side, you're working E&S, you're working for the money. The money is not working for you. As long as you're on this side of the quadrant, you're always going to be working, right? Unless you decide to shift to the other side of the quadrant, there is no way to be financially free, right? This is a loop in itself where you can just be here all the time. So the other side of the quadrant, there are two things you can do. One is to own a business where you have employees and they are working and you're making money, right? But obviously you have to oversee your business, but there you can get to the point in your business where your employees can still work while you're away, right? So you're creating work when you're basically taking yourself away from the equation. If your business is well managed, you're not the bottleneck in the business, right? So your employees can still make money for you. And the additional factor in businesses is you get a lot of tax breaks. The reason is you have expenses in a business, you have payroll, you have this, you have that. You can invest for real estate in a business. You can have your business pay for your phone. You can have your business pay for a part of your house because now your house is your office, So as you go to this side of the quadrant, you'll start seeing more ways to reduce your taxes. And as you come to the investor side of the quadrant, you'll start seeing even more ways because now you're not restricted to running a business. You can invest in a lot of different things. And I put in zero or no effort, right? As you get to an investor status. So the income does not depend on active work, although I'm an active investor right now. I actually do a lot of work, but I enjoy it, right? You don't have to be an active investor. You can be a passive investor. So your money is really, truly working for you and you get a lot of tax breaks here. So let's say you have passive income from investing into something. You have a lot of depreciation on that asset, so you can offset your passive income. So we'll talk a little bit about depreciation. And that's probably the slide for it. So you're navigating taxes now. Let's talk about taxation. So this is a very interesting concept where if you're working in a job for a lifetime, you're always going to pay taxes. You're also going to pay taxes later on your 401k when you withdraw. A lot of people think somehow that they're going to escape taxes, but someone said, Abraham Lincoln, I think, said there's only two things you can't escape: death and taxes. It's like that. But if you can figure out how to become an investor full time or run a business, there's just a whole lot of ways you can escape taxes or reduce taxes very legally, right? There's no illegal stuff here. So let's talk about the types of income, and then we'll talk about the types of investments that can give you tax breaks or maybe not. And then we'll talk about the types of taxes that, or how you can save taxes, and then what results we can get from it. So you have active income, which is a W-2 or a 1099 income. You have passive income, which is usually like K-1 income or reported in other ways, partnership income. You have capital gains. They could be short-term or long-term capital gains. If you sell stock, you sold a house, different ways to create capital gains. You have dividend income. So you invested in a dividend paying stock, you have dividend income. You have interest income. So you have a bank account or you have some investment that's creating some interest, and then you're getting income from it. So broadly, these, I'm sure there are other kinds of income, but let's talk about these, right? So you could be investing in stocks. Stocks by themselves don't make an income until you have a sale, right? And then you have capital gains. You have real estate. You will also have capital gains, short-term or long-term, depending on how long you're holding the real estate. It's something called opportunity zone that can give you great tax breaks. So that's something to look at. Oil and natural gas. A lot of people don't understand how to navigate taxes for W-2 employees. Oil energy investments happens to be one place where you can actually write off your W-2 income. Using the business losses from oil and gas. And it's not really a loss. It's more of a business expense that you can write off. Or let's say you decide to open a business. You obviously have some way to, or invest in a business. These are all the investments you can make, right? So when you make an investment in any of these 5 things, it's quite possible. Stocks usually, again, you don't have any way of getting out of a stock gain. There aren't too many ways except opportunity zone. So usually in terms of taxes, you have what's called depreciation. In terms of tax savings, depreciation is essentially a passive loss. It's a loss, but it's not a real loss. You take the value of the house, let's say, that you're renting out. Let's take a rental home. Now, let's say the rental home is worth $250,000 and I have a $50,000 value in the land. That means the structure is valued $200,000. So what IRS says is, since the structure has a certain lifespan, they consider that at 27 and a half years, you can depreciate that asset over that 27 and a half years. So you could take 200,000 divided by 27 and a half and take that number as your tax break on any rental income that comes in. So let's say you rented the house, you had some expenses, you made a couple of $100. If you have more than, let's say 24, you made $200 a month or $300 a month. At the end of the year, you have 12 times 3, $3,600 in income. But if you can create $3,600 in passive losses, which is the depreciation on that asset, which you easily can, you don't pay any taxes on that $3,600 you earned. So this is how real estate really helps you create, pay less taxes, because the income from real estate is usually tax-free, right? At least tax deferred, right? It's recaptured when you sell, which is why we don't sell. We usually 1031 exchange. Then we have business expenses. If you decide to start a business, all of the expenses are write-offs on your income. So you can figure out how to structure the business to take more write-offs. So there's a lot of things you can do here to increase your write-offs when you have a business, but it's very, very hard to do all that strategy when you only have a job, right? A job really restricts you in terms of what you can do. So you can have a job and something else, but if you just have a job and that's all you want to do, financial freedom isn't for you, right? And then we have active losses. So active losses can be created by investments such as oil and natural gas. What that really means is you can take those losses and apply it towards active income. So broadly, active losses offset active income, passive losses offset passive income. That's really how it is structured. There are exceptions to the rule, and I'll talk about it. What are the results you want from navigating this whole tax strategies here? You want to pay little or no taxes and increase your cash flow, because you're making a certain amount of money. You want to make more money without trying to up your effort, and you want to increase your net worth. So let's talk about, this is just a recap of 5 steps. Examine your money beliefs, invest in your education, surround yourself with people, save or learn how to earn more. So a lot of people say, I can't save. So you got to learn how to earn more. Invest into assets and increase cash flow, rinse and repeat. That should have been, that slide should have been there before, but we'll fix it next time. So let's look at tax breaks for investors. So when you're an investor, especially a full-time investor, it becomes a lot easier to create more tax breaks, because you have this real estate depreciation. There's also additional strategies that you can apply with homes and with real estate, especially where there is a structure involved. You can't really do all these strategies with just land purchases, because there is no structure to really depreciate when you have a piece of land. But once you start doing a building on top of that land, you can do a lot of these things. Actually, you can interestingly do a bonus depreciation and cost segregation on golf courses, even though there is not really a structure, because there's a lot of valuable like grass and other things on a golf course. So Trump made a lot of his bonus depreciation from golf courses, from investing into golf courses. So cost segregation, bonus depreciation, you can look them up, but the strategies are essentially to increase the amount of depreciation you can get from the property. So let's say I have a $200,000 dollar property. Now, instead of 27 and a half years to take that depreciation, let's say I can get 80% of it in year 1. Those are the strategies. Cost segregation, bonus depreciation are strategies which allow you to take that 80% of $200,000, $160,000, and create that as a negative income or loss on your tax bill, right? So there are opportunities to do this. And what's interesting is if you become what is called a real estate professional for tax purposes, all your passive losses from real estate and other ways become active, okay? So if you're interested to learn more about how to become a real estate professional for tax purposes, I have a webinar on my YouTube channel, and I'll share the link with you in a little bit. But there's a webinar on how you can become a real estate professional for tax purposes. And when that happens, if you create any passive losses, they become active losses. What that means to you is you can offset W-2 income, you can offset 1099 income, you can offset capital gains, you can offset dividend interest, any of those things, right? So I'm not a tax advisor, but this is something I've done for myself. So I do know that it's doable, and I've done it for years now. So let's talk about how can you create tax breaks as for you as an employee, right? You're a W-2 employee or you're a 1099 employee. How do you create some tax breaks? You can do oil and natural gas investments. They generate active losses. I'm happy to refer you. I have a company which does these oil and gas investments. You do have to be an accredited investor, but they do provide active losses on your W-2 income, which means you can offset your investment amount on these investments against your W-2 or 1099 income. There's also something called a short-term rental tax loophole. You can look this up. So let's say you're a W-2 employee and you decide to buy a short-term rental. If you spend 500 hours on the short-term rental, setting it up, managing it, and doing all of that stuff, these hours, the time, you can take the short-term rental and do this cost segregation, bonus depreciation on it. And whatever depreciation that short-term rental generates becomes active loss for you. So that means it offsets your W-2 income. So you can Google short-term rental tax loophole, and you'll actually see this when you log in. I mean, when you Google it, okay? There's some videos on it. There's a lot of information on it. The third thing you can do is consult part-time. So let's say you're an IT professional and you really are, taxes are really killing you, right? So you can decide, hey, I'm going to consult part-time. I'm going to work 740 hours in IT. I'm still going to have work and I'm still going to have income, but I'm going to spend 750 hours in real estate. The only catch here is you have to spend 1 hour more in real estate, specific activities in real estate, than you are in your full-time job. You can have a full-time job that you spend more hours on than real estate. IRS won't take that as a real estate professional. This gives you, when you become a real estate professional for tax purposes, it gives you a lot more ways to reduce or even pay zero taxes. The fourth one is to work full-time and you have your spouse spend 750 real estate hours. So what's interesting is you can have a spouse who's working full-time and one more person in the household who's actually becoming a real estate professional for tax purposes. Both of you benefit from it, right? So let's say this is a very important one, especially when you have a high earning spouse. You want to let them work. Let's say your spouse is a doctor and you are an engineer and you're not making anywhere close to what they're making. You're probably better off spending your time in real estate and getting a real estate professional status, because you could probably create enough depreciation that becomes active losses against their income, and it will probably cover your income. Especially in states like California, that's so easy to do because people pay 55% in taxes. And if you can save 30% of that 50, knock it off, it actually covers one person's income, which is when it's not too high an income. So these are like sort of cheat sheets for people who want to learn how to do these things, and it's very doable. The fifth one is to work full-time and your spouse starts a business. I think businesses, especially if you're passionate about something, have no upside, right? You can do whatever you want and the sky's the limit. And it also gives you tax breaks along the way, which you cannot get when you're working full-time as an employee. So the minute one of two people in a household move to the right side of that quadrant, you start creating opportunities for creating more tax breaks. And sometimes, depending on how you get there and how quickly you get there, you can probably replace the income of one person just with tax savings, especially if the other person who's working full-time has a large income. All right, here's some recommended reading for you guys. I'm going to share this deck later just so you guys have it, the list of reading. Rich Dad, Poor Dad, definitely something you want to read. And this Think and Grow Rich. And I think these are mindset books that I really enjoy. And if you have a Spotify account, there's an audio book for free on Think and Grow Rich. Go for a walk and listen to it. Tax-free wealth. So the gist of this book is what I just told you. If you're always on the left side of the quadrant, there will be no ways to create tax-free wealth. If you get on the right side of the quadrant, there is a zillion ways to create tax-free wealth. And the reason for that is really, really simple. IRS looks at, if you look at taxes traditionally, like for hundreds of years, when people create more jobs and invest in the economy, they are rewarded by paying less taxes. And it's really as simple as that. If you're going to work every day and just creating one job, which is yours, and earning income for yourself, you're not benefiting the economy in any big way, as much as when one person can create 10 or 20 jobs by investing in businesses, investing in real estate, investing in other assets, you create much more for the economy, right? So you're rewarded with tax incentives for creating much more wealth. Think and Grow Rich is more a mindset book. Highly recommend that. I also love the 4-hour work week. My goal was to get to the 4-hour work week. And I realized somewhere along the way after I quit that I enjoyed work so much, it became a 50-hour work week and a 70-hour work week. Now I'm dialing back and again going back to what is it that I enjoy doing, focus on myself. And I think what's interesting is that this is a continuous learning process. You do something and you course correct, and now you realize, oh, this is not what I wanted for myself. I'm changing, I'm learning. Just a little bit more, if you want to really learn more, feel free. And I would really appreciate if you could subscribe to my channel. I'm trying to add more videos. And if you want to just email me and let me know, hey, why don't you speak about this? Give me some topic suggestions. I do short videos, 10, 20-minute segments of things that people want to learn and understand. I have these shorts over here, sometimes 1 or 2 minutes. Actually, shorts are less than a minute. So if there's a burning topic, something you want to learn about, shoot me a text or shoot me an email and let me know. And please subscribe to my channel. I don't know what I did there, but something happened there. Okay, I clicked on my channel. That's what happened there. All right. I also have an investor group on Facebook. Feel free to join this. We have about 860 investors in this group. Post constantly, like talk about different webinars, talk about different topics of learning about investments. So you're welcome to join this one. It's called Purely Passive Investor Group. Again, thanks for joining. Please visit me at cherrystreet.us if you want to set up a call with me, say hello, or just drop a note. It's Kavita at cherrystreetinvestments.com. I should have put my email here, but thank you for joining. And I think that's all I got. I'll take some questions if you guys have some. Would love to talk more with some of you if you guys want to talk. Thank you again for joining. Let me see what the questions here are. All right. Okay, somebody said one-on-one call. I will be sending a recording of the session to everyone. If you want a one-on-one call, please go to my website, cherrystreet.us. There is a schedule a call button, and you can schedule a call with me. I will get back to you on that. Thanks, Stephen. Thanks for joining. Thank you. Yeah, let's see if there are any questions. Okay, so someone asked, this is a good question. Do you recommend that just take all my money from 401k, even with penalty, to buy real estate? No, you don't want to do that. But there is another way to take money from your 401k without a penalty and actually buy real estate. So if you have quit your job, right? If you are, let's say you have an old 401k, there is no need to pay penalty. I actually invest my old 401k from IBM and my old employers into real estate, 100% into real estate without penalties. The reason is you can roll over your 401k into what's called a solo 401k or an IRA. Or just a self-directed IRA. I recommend looking at self-directed IRAs. You can roll over 401k to a self-directed IRA without any penalties because it's still a retirement account, and you can invest a self-directed IRA into real estate. Okay, so there's no need to pay penalty. Would never advise you to pay a penalty to buy real estate. What's the primary way that I earn passive income? Okay, good question. I don't really have a primary way. I have a lot of different ways. So my income comes from single family homes, some of them, some part of income. I have a lot of investments in multifamily, ATM machines, energy investments, parking lots, parking assets, mobile home parks. I'm trying to think about all my investments. I've just really diversified across the board. So there isn't like one thing that I do which earns me passive income. I also have a lot of affiliate income. Yeah, just a whole bunch of different things. I don't recommend there's like one way of earning income. Maybe initially when you start, and you want to focus on something, maybe you figure out one way of doing something that is more active than passive. Really, you're spending a lot of time learning about it, but after that, you can diversify. The more you can diversify into different assets, the better it is, right? Do I need an LLC for oil and gas investments? No, you shouldn't need an LLC. If you want to, you can set one up. Again, people really worry too much about a lot of these funds, especially we have multiple layers of LLCs, so the liability is quite minimal. And they carry a lot of liability insurance as well. So you don't really need the LLC, but if it gives you some peace of mind, by all means, do an LLC. All right. Any more questions for me today? All right. I think that's all for tonight. Thank you guys for joining. Appreciate. I hope this was worth your time. And please let me know if you have any other questions. Okay. Do you recommend LLC for investment property and rental houses? Yes, most of the time, yes. Again, it depends on how many homes you have and how much liability you're willing to take on and set up LLCs for individual properties. I'll give you an example. Instead of putting every home in one LLC, the problem is you can't take 20 homes and put it in one LLC, then you risk the liability becomes around those 20 homes and you can risk losing all of them if you have a lawsuit. So again, in Texas, I don't want to set up one home, every LLC, and spend $450 setting up an LLC per home. It didn't make any sense for me. So I took a lump of like, oh, okay, these homes are worth around $1 million. I'm going to put all of them into an LLC. I put another $1 million into another LLC. So you could figure out different ways to do this. But if you have starting with one rental home, I'd say, you know what, just buy an umbrella policy to start with. Own it in your personal name and own an umbrella policy, which will cover you in case of a lawsuit. And I think that's enough to keep things simple. But as you start expanding your portfolio, you might want to start considering having an LLC and then transferring these assets into the LLC's name. All right. Looks like we have a couple more questions coming in. All right. I think that's it. All right. This time we're done for real. Have a good night, everyone. Thank you for joining. Hi, I'm Kavita Bartake. I hope you found this video useful. And if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching, and thank you for supporting me.